Thanks, Mark. Last word belongs to you. So you can...
Standing between us and cocktails?
Yes, we'll talk fast. Look, we've heard some reasons to be very cautious today from folks. We've heard some reasons to be a little more optimistic. Like getting late in the evening, I'll throw a softball your way. What do you think?
First, I want to say congratulations on the 1-year anniversary.
Thank you.
Big deal. So I'm optimistic about that.
Thank you. Media is a notoriously great growth business.
Well, evidence of innovation in capitalism. Short term, I think the market is still coming to terms with the reality of, up front, you said, money that costs something. And we had 15 years of money costing nothing, and 25 years before that, 40 years in total, where you really look smart by levering up. That's over. So I think we're going to go through this reckoning. We're going to see it in commercial real estate. Maybe we'll see it more in some banks. But on the other side of that, if you look long term, I think we're looking at a financial system that unsung heroes, the bank regulators, actually are going to get us through a huge monetary shock without actually having systemic problems. And we're going to have a financial system that's actually actually more stable on the other side. And then the last thing is, I would say, when I talk to global investors, the place they want to invest their capital is the United States. And if I had to say the biggest shift in the last 5 years, it would be, they used to say China and the US, and now global investors say they want to be here for the reasons that Gary was talking about, but also around the reasons that China has made itself a less attractive destination.
I'm going to read a quote to you. I do see some very large opportunities for inorganic growth. That was your boss,
well,
Larry Fink.
He does say things like that, doesn't
last
he?
Week, sounding awfully acquisitive. CEOs don't say things like that unless they have some plans. Without asking you a question you're absolutely not going to answer, what businesses, where is BlackRock not that it should be? Where should it be bigger?
So actually, we've been pretty clear about that. Our whole business, in our little corner of financial services,
little
which is asset management.
It's quite a large
It's pretty
corner.
little compared to the big boys and girls in insurance and banking.
Sure.
We are, there's actually the acquisitions that work are defined by only one thing. Does the client, not the company, but the client come out of it with a better experience? So what will we acquire? It will be things that actually lead for us being able to serve our clients much more fully for the things that they're looking for. And it's pretty simple. If you look where the demand is, where the value is shifting in our sector, it's moved in areas where we've done inorganic moves and we'll do more, which is around private markets and around technology.
It seems like investing has really barbelled into this incredibly low fee, mostly passive ETF business that you dominate with a couple of competitors.
We don't dominate anything, we help lead.
Very, very competitive market. And then, still very pricey alternative asset management. Which you, I think, have done some things in, but clearly are not at the scale that you are there. Am I thinking about that right? It's sort of a very mushy middle, tough to be there, and this is an area that you are not particularly big in. Do people want to come to you and you say, we can do everything from private equity buyouts to infrastructure all the way through to S&P 500 ETFs?
Yes, if you looked at the dominant trend, I would call it, in any form of client we have, that's pension plans, insurance companies, individual investors, wealth managers all around the world, they're looking for one thing. They want more and more with fewer and fewer asset managers. By the way, you'd find the same thing in sales and trading or investment banking. Concentration is being driven not by acquisitions, but by clients saying, I want a little bit more to do more with you, Liz, but by the way, I'd like a lower price on that. And so that's being driven across everything. The place that captures the most consciousness in our clients' minds where we're not as able to serve as we'd like to, because there's more out there than they want to do more with us than we can fulfill today, is going to be around infrastructure, credit, real estate, private equity, particularly growth equity. And as an example, as we launched the growth equity strategy around what I think is one of the dominant trends, this is dominant, trends in our lifetimes for investing, which is around the transition to a low carbon economy. We've never had a growth equity strategy before. We've launched this in partnership with a large sovereign wealth fund, Temasek. And our first fund, in the middle of gale force winds, is probably going to come in, actually on target, around $1.5 billion. That's amazing. Why? Because clients want to do more. But you actually have to have a product. And we don't have all the products that we did.
Okay. I don't think it would surprise you to learn that people think you are on a short list to replace Larry if and when.
Well, this is getting saucy.
Well, we're very close to cocktails. Larry is a founder CEO. not that many of them left outside of Silicon Valley and been there as long as he has. Given you any indication of his timeline?
So it's a privilege to serve. Look, Larry is a founder CEO, and what you see is what you get. This guy is vibrant. He's also loving what he's doing. So what I would say is, if you're working at BlackRock and you don't like working for Larry Fink, this is probably not going to be the right place for you.
Okay. We're talking about ESG. We can debate whether that even means anything anymore, but look, BlackRock was an early and pretty vocal champion of the idea that on some level companies have an obligation to be good citizens beyond just making money for their shareholders. And then that became extremely politicized, and BlackRock, I think, found itself in the spotlight. And I'm curious kind of what you learned from that. It seems that you've been quieter over the last year on the topic.
So I would say speak softly and invest money has been where our guideline. Coming back to this point around from the beginning, if you look very carefully, including in Larry's letters, because that's where everybody goes to, he's always been clear, we've been clear, it's always about long-term shareholder value creation. We've been very clear on that. Ultimately, the being a good citizen, where you're rewarded by your community, by your customers, by your employees, by your suppliers, that actually that's the lens. So it's important, it's a capitalist impulse. In terms of where clients have gone, just to give you a sense of how much shift there's been, back in 2019, we had about $100 billion of sustainable AUM assets. That number is over 700 today. So our clients globally are voting that they actually want to shift how they invest for higher attention to that. The transition to a low carbon economy, that's already from like up 10 times. All this is said, there's huge investment opportunity and demand from clients. What I think the world is saying is invest. We don't need as much talk. And so we've been a little quieter because actually that's what our clients are looking for.
Got it. Talk more about private markets. I mean, so much money has gone in their private credit in particular. The biggest mortgage lender in America is not a bank. The biggest, financiers of LBOs, not banks. Curious where you see the opportunity, and then also just, it's hard for me to imagine that much money goes into an asset class that quickly and there aren't some accidents.
So you got to see what the primary driver is. So the reason that the biggest mortgage lender is not a bank, and the second biggest, which actually we helped found, is not a bank, is not because, it's because the whole world is looking for a different way of intermediating financial risk. And it got accelerated after the crisis. So if you go back to the crisis, bank regulators said, we're not doing this again. A lot of fun and games, and they've basically cramped down on the liquidity, capital, and leverage of big banks. That squeezed lending demand to other corners of the financial system. It's gone chiefly into what we call private credit, which goes into, it's really nothing but insurance companies and pension plans lending money through asset managers and agents. Now, what does that mean? It means there's probably less credit than there would have been otherwise, because banks are much more leveraged than insurance companies or pension plans when they lend money. It also means that in the event of, let's say, commercial real estate problems, the system's vulnerability to funding is much more reduced than it would be in a world that is more bank dependent. By the way, banks are still really large, but it's less dependent because when an insurance company or a pension plan wants its money back from a private credit mandate or from a loan they've made, they got to wait 5 years. You can't just pull the money out immediately. Banks are inherently, there is no way of getting away from Gary's point that they're inherently unstable. So ultimately what we're seeing is a deleveraging of the financial system, more credit going from very long liability institutions like pension plans, and probably less credit creation. And that discussion is a little unformed. People haven't really thought through, but it all comes back to Basel. Basel III, Basel's so-called endgame that is pushing this credit creation into other corners of the financial markets, like the ones you mentioned.
We made it so long this evening without mentioning Basel. I want to ask about that because banks, to your point, there's run risk all the time. There's things you can do to mitigate it. But the surest way to get in trouble doing anything is to be illiquid. And we saw there were a couple of rumblings about this, BCRED, BREIT last year.
Illiquid if you have short-dated liability.
Yes.
That's the key. Yep.
To have people want the money and you can't give it to them. And liquid alts has been a strategy that's gained a lot of popularity, which is essentially we've already sold all the alternative stuff we can to institutional investors, so we're going to try to sell it to retail, and there has to be some liquidity guarantee in there. And it turns out that it's hard to meet them all the time. You can gate them. And
So I was sitting in a private bank, really big global private bank based in Europe, and they said, could you create a product where you'll guarantee that our clients can get out at a deep haircut? And I was like, absolutely not, for two reasons. We're not going to steal from your clients, and second, the time when they want to get out is by definition a financial panic. So this mismatch, which you're getting at, you'll see it in UK open-end property funds, where basically, theoretically, you have the right to pull out cash immediately, except it's sitting in buildings. These structures, they come up at the end of very frothy periods, and then they die. And I think one thing I'd really stress is people poking at, including at competitor products that have actually performed as they were supposed to, is look at the liability structure. If people can't pull the money out, it's going to be okay. And coming back, ultimately, could money be lost in private credit? Well, if we listen to what Scott was saying before, the answer is yes. A lot of those office loans are not going to get paid back. But the societal problem that happens, it's capitalism. But are there systemic problems triggered from that? And I would say we're moving to a more stable financial system in terms of basically assets being matched more with liabilities, as opposed to the financial crisis, which is nothing more simple than when we saw in It's a Wonderful Life.
Yes, money's not in the bank, it's in the house. I have time for probably one more, and this sort of active versus passive debate, which I think it's been going on for a long time. Clearly, a lot of money moved to passive. It's been a very tough decade or so for particularly badly performing active managers.
Or even mediocre performing. Yep.
Sure. How much more room is there? How much more market share can go to passive before something breaks?
So I actually think the story's moved on from active versus passive, because that was the story until, I'd say, 4 years ago. What's changed now is customers are not thinking active versus passive. They're thinking price, value for money. And so what we're seeing now is, yes, of course, you're seeing the continued growth of index equities, for example, and index fixed income. But the really big impact has actually been on price competition on active mandates in a world that actually didn't even have price competition 10 years ago. So that world is shifting. And so basically customers are saying in a world where money costs something, actually, I want you to really show your value for money. And if you're really good, I'll pay you. And if you can't prove to me you're really good, I really need you to knock the price down dramatically. And so that's the price pressure it's feeding, but it's not really active versus passive. The whole industry is facing price compression. It's just that indexing was way ahead of that.
Yeah. Thank you so much. What a great chat.
Thank you, Liz. Thank you.